There are many forms of real estate investing, from investing in residential properties such as homes, condominiums, or apartment buildings to commercial properties such as malls, offices, or hotels. There's even opportunities to invest in industrial property such as factories and warehouses. There are also other forms of more indirect or passive investing in real estate. These include REITs, real estate crowdsourcing platforms, as well as syndicators, who are middlemen who bring in investors with cash and buyers and put deals together, offering a percentage of profits paid out to investors. The purpose is still the same: to make a profit in the real estate market. In this video, I'll focus on REITs, which are real estate investment trusts, as a form of investing to create passive income, and how you too can create consistent passive income using REITs without having to invest heavy capital on down payments while still generating comparable to or sometimes greater ROI than traditional real estate. Get ready, you are now entering the Academy. REITs stand for Real Estate Investment Trusts. They're like mutual funds publicly traded on the stock market and basically comprise of companies that own, operate, or finance income-producing real estate such as office buildings, real estate, retail spaces, apartments, and hotels, for example. REITs are a completely hands-off or passive type of investment. REITs pay at least 90% of their taxable income in the form of dividends each year. You don't own any of the real estate and are just receiving a dividend for placing your money into the fund. REITs can appreciate or depreciate over time as the company buys or sells assets and makes profits or takes losses. Investments in REITs are great for retirement accounts and long-term investments that pay dividends. However, they are not tax deductible and don't share some of the advantages of investing in physical residential properties. Let's take a step back and define what dividends are. What are dividends? A dividend is a payment made by a corporation to shareholders, usually as a distribution of profits. When a corporation earns a profit or surplus, the corporation is able to reinvest the profit in the business and pay a proportion of the profit as a dividend to shareholders, also referred to as dividend income. Not all companies offer dividends. Dividend yield represents the annual return that is expected to be paid out in dividends. So for example, a dividend yield of 3.2% represents an annual return on investment of 3.2%. Payments are usually broken into quarterly installments paid out every 3 months throughout the year. Some companies, however, usually pay out monthly dividends. The amount distributed is calculated by the following formula: stock price times yield divided by 100 divided by 4 for quarterly dividends, and stock price times yield divided by 100 and then divided by 12 for monthly dividends. Dividend income is the income a shareholder receives from dividend distributions, either every quarter or every month. Although it is taxed as regular income, dividend income can be scaled into a substantial income-producing asset for your portfolio. Through careful planning and diligent investment of capital, as well as reinvestment of dividends, one can create a dividend income stream that can provide substantial income. A REIT's dividend income portfolio is a portfolio consisting of primarily dividend income paying REITs with the goal in mind of diversification among the REITs, as well as value investing and creating a monthly, sustainable, and ever-expanding source of income. Ladder stacking dividends is a process of creating a portfolio with a set number of REITs that, when combined, will pay you monthly dividends. While some REITs pay monthly dividends, it is sometimes impossible to build a portfolio with solely monthly dividends. Quarterly paying REITs can also be used to create a desired portfolio of high quality REITs that, when combined, pay a monthly dividend. Now we'll go over one REIT which can be used to start your income producing portfolio and which is still undervalued and with room for growth. REITs have seen massive selling in March, followed by almost V-shaped recoveries ever since. Yet many stocks are still trading at very attractive prices, although their businesses have really not been affected by the pandemic. One of these is triple net lease REIT WP Carey, ticker symbol WPC, which dropped as low as $38 from its February highs of $88, before sharply recovering to its current $66 price level. Other REITs have had similar price actions. Fears of WPC's ability to collect rent in April and May have pushed the stock price on this roller coaster ride. Yet despite impressive 96% and 94% rent collection rates in April and May, the stock is still down 17% year to date and down 27% over the last 9 months, which makes no sense at all. What makes WP Carey different than other REITs? Companies like WP Carey finance the purchase of lucrative and attractive properties and then rent them to tenants in the retail sector. Whatever is the difference between financing the cost and rental income, the REIT will account for as profit minus other expenses. Now obviously the perfect time was to buy the stock in mid-end March 2020, but even today, with the stock only down 17% year to date and over 25% from its all-time highs, WPC offers a very attractive investment opportunity. WPC is a high-quality REIT which owns 1,215 net lease properties with 352 tenants spread across the US, which encompasses 63.7%, and Europe, which encompasses 34.2%, as well as other regions which factor in 2.1% in North America and Japan. WP Carey is neither a retail, an office, a warehouse, nor a retail REIT, but instead is widely diversified across many property types and tenant industries, which insulate the business well from local market disruptions. Actually, those 4 property types are mostly equally weighed at around 17 to 23%, with the industrial and warehouse section accounting for 46% in total. The retail sector, which is the one currently affected worst by the pandemic, accounts for only 17% of the portfolio, but it should be noted that COVID-19 sensitive tenant industries such as retail, which accounts for 22.3%, and automotive, which accounts for 6.8%, and hotel, gaming, and leisure, which accounts for 3.9%, have a higher weighting. In April, it collected 96% of rent due, with the only property type showing problems being fitness, theater, and restaurant businesses, where rent collection came in at around 10%. Given that this property type only accounts for 2% of total ABR, the impact was negligible. Despite this, the retail sector, which accounts for 17% of ABR rent collection, came in at 97% in April as well as May, highlighting WPC's very strong tenant base. This is a remarkable performance amid one of the most challenging economic times ever, and a testament to WPC's strong tenant base. Its top 10 tenants, which feature strong tenants such as U-Haul International, Hellweg, Metro, and Extra Space Storage, account for 22% of ABR. The average lease length is around 10 years for the entire portfolio and even longer, with 13.1 years among the top 10 tenants. WP Carey has a strong history of income generation, featuring 20 plus years of consecutive dividend increases since its IPO in 1998. In recent years, the dividend growth has slowed down, notably from a 10-year average of 6.16% to a 5-year average of 2.36% and an annual dividend growth of just above 1%. It is unlikely that this pace of dividend growth has any upside right now, but at the same time, the current dividend is relatively safe. Its Q1 2020 FFO payout ratio stands at 83%, representing a solid metric for a REIT. The current dividend yield of 6.2% provides a strong incentive for investors to look past the slow dividend growth in recent years. In these times, it is more important to have stable and reliable income than having to deal with dividend cuts or suspensions. This video covered one of the safest forms of real estate investing, which is investing in REITs. Specifically, to start a REIT dividend portfolio, WP Carey is a great choice for a REIT. In addition to investing in this REIT, adding to this position systematically by dollar cost averaging, as well as reinvesting the dividends to grow the position, will generate a strong passive income stream in the long term. Be sure to check out the links in the description to get started investing in this REIT using the free stock trading app Webull. And if you open an account now and fund just $100 that you can use to invest into WP Carey, you can get up to 3 free stocks worth up to $1,600 each. So take advantage of this promotion while it lasts. Thank you for watching this video. If you enjoyed watching, don't forget to smash the like button. It will really help out the YouTube algorithm in bringing you more passive dividend income strategy videos. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.